You sit alone in a glass conference room as an advisor slides a polished private placement deck across the table. It stops at the signature page, where your name is already typed. He congratulates you for meeting the accredited investor criterion. The sentence sounds like a status upgrade. A door has opened, and you are standing on the approved side of it. But accredited investor status is not a safety certificate. Under SEC rules, the definition can include more than $1 million in net worth, excluding your primary residence or qualifying income above specified thresholds, subject to the rule's conditions. These are examples, not a complete eligibility test. The rule also includes conditions for joint income or net worth and addresses liabilities associated with the primary residence. It defines who may be allowed into certain offerings. It does not certify the manager, guarantee the valuation, endorse the projection, or decide whether the investment belongs in your life. The advisor tells you the company owns a fast-growing portfolio of specialty warehouses. A blue line rises across the page, smooth and confident, ending at a number large enough to change how you picture the next decade. You imagine the house repaired before it needs repairs and fewer conversations about whether a purchase is sensible. The information is arranged differently from a public purchase. A bright summary first, followed by dense offering documents, assumptions, conflicts, fees, expenses, and risk disclosures. Private placements may provide less public information than registered offerings, and they may be highly illiquid. Nothing in the elegant deck guarantees that the projections will arrive, that the valuation is current, or that another buyer will appear when you want your money back. You ask the ordinary question the presentation has avoided. When can you leave? You compare the opportunity with the exchange-traded index fund already sitting in your brokerage account. Exchange trading generally provides continuously updated quoted prices and an opportunity to submit orders during the trading day, but execution and price are not guaranteed. Your account can fall before breakfast. Still, it gives you a recurring answer to a basic question. What is this worth right now? That visibility can be uncomfortable, but observable pricing and an opportunity to submit an order are different from a promise that the order will execute immediately or at a particular price. The private deal gives you a different kind of number. If it reports a quarterly value, that figure is an estimate produced through a valuation process rather than a continuously observed market price. The estimate may be reasonable. It may reflect careful work. It is still an estimate. You notice that the return chart is smooth. The line does not jump or shudder like the public market screen. For a moment, smoothness feels like stability. Then you understand what the line is really telling you. The number is updated infrequently. The underlying risk has not disappeared simply because it is not being displayed every second. The advisor says the investment is designed for patience. You nod, but the word stays in the room. Patience sounds like a virtue when you choose it. It sounds different when the structure requires it. Depending on whether this is a fund, direct private placement, or another structure, your exit may depend on a fund term, redemption limits, a secondary buyer, an asset sale, or a manager's process. Long-term may mean that your capital remains unavailable for years, even if your circumstances change sooner. You imagine a major house repair, a business opportunity requiring cash quickly, or a family emergency that does not care about a notice period. The investment can be profitable on paper and still unusable when you need money. This is the first private consequence of the door opening. You may have exchanged some control for access. You turn to the fee page expecting 1%, and find a structure instead. There are management fees, possible performance compensation, expenses, and costs embedded in the arrangement. The exact effect depends on the documents and the deal, but the principle is simple. The return shown to you is not the same thing as the money you keep. A projected gain can be reduced by fees before taxes. Taxes can then be affected by the kind of income or gain eventually realized. Complexity itself can make a good-looking investment hard to compare with a simpler one. Then the advisor asks for a complete balance sheet view. This private investment is only one piece. A large portion of your wealth is already tied to your employer's shares, a property portfolio, or a private company you helped build. On paper, you have several accounts. In economic reality, they may depend on one sector, one city, one business cycle, or your own continued attention. You had been calling this diversification because the statements were stored in different places, but separate accounts do not necessarily mean separate risks. The SEC describes diversification as a way to reduce risk, not a guarantee against loss. Sophisticated access may have made your portfolio more complicated without making it more resilient. The next document does not ask how much you can invest. It asks how long you can afford not to touch it. You ask again, plainly, when do I get my money back? The advisor stops giving calendar language. The answer becomes a process involving, depending on the structure, fund terms, asset sales, valuation methods, notice periods, available liquidity, and the manager's decisions. The legal documents explain that circumstances can delay or limit an exit. Nothing has necessarily gone wrong. This may simply be how the structure works. But your mental picture changes. You are not buying a thing with a price. You are entering an arrangement whose value and timing will be reported to you. Now you stop asking whether the advisor sounds confident and begin asking what can be checked. What assets does the vehicle own? Who values them? And how often? What fees are charged at each layer? What conflicts could influence a sale or valuation? What documents describe redemption limits, extensions, and expenses? What would have to happen for the optimistic projection to fail? How much of your portfolio could remain unavailable at once? These questions do not make the investment safe. They separate a risk you understand from a risk that is merely dressed well. The advisor answers carefully. The room remains impressive. The answers remain conditional. Before wiring the subscription money, you move cash between accounts and notice an illustrative balance of $300,000 sitting in one ordinary deposit category at one insured bank. The number feels reassuring because it is liquid. It is money you can see and, in principle, use tomorrow. But FDIC insurance generally covers up to $250,000 per depositor per insured bank for each ownership category. The full balance is not automatically covered merely because the bank is insured. Coverage depends on the depositor, the institution, the ownership category, and the account structure. This is not a reason to panic, and it does not establish that a particular uninsured loss will occur. It is a reminder that even safe cash has conditions worth checking. You consider moving the money, then remember that protection at a brokerage would mean something different again. Your public brokerage account contains shares that have fallen sharply. SIPC protection generally covers up to $500,000 at a failed SIPC member brokerage, including a $250,000 limit for cash claims, subject to applicable rules. But SIPC does not protect you from the market value of a stock falling. One risk concerns a failed custodian and missing assets. The other concerns an asset you still own becoming worth less. Different protections address different failures. Neither turns an uncertain investment into a guaranteed one. Then a familiar phrase, "You can always sell some shares," opens a tax problem you cannot see on the trade confirmation. You sell appreciated public shares to fund the private investment. The proceeds settle, and for one evening, your account looks larger than it has ever looked. The next morning, the trade is no longer just a purchase decision. IRS rules distinguish short-term and long-term capital gains based on how long an asset is held, with potentially different treatment. If income is not sufficiently withheld, investment income can also create estimated tax obligations. The exact result depends on your basis, holding period, income, deductions, jurisdiction, and asset type. You do not subtract a universal tax percentage in your head. You reserve cash and ask for a calculation before treating the proceeds as fully spendable. A week later, the same access that impressed the advisor reaches your family. Your sibling hears that you were invited into a private deal and asks for a large transfer to repair a home. You want to help immediately, especially now that the advisor has made your capital feel abundant. But a large gift is not only an emotional moment. Federal gift tax consequences and reporting requirements can depend on the transfer, the amount, the recipient, and the surrounding facts. Reporting may matter even when no immediate tax is due. You do not accuse your sibling. You do not promise a number on the spot. You say you will review the transfer with qualified tax advice and document what happens. Wealth has not removed the relationship. It has added records to it. You return to that page and read the accredited investor definition again. Now the sentence sounds smaller. It explains why the offer can be made to you. It does not tell you whether the manager is capable, whether the valuation is reliable, whether the projection is realistic, or whether the concentration fits your life. Alternative investments can involve limited liquidity, complex structures, high fees, and substantial risk of loss. A private placement may be offered because of your financial status while giving you fewer ordinary ways to verify its value or sell it quickly. Eligibility is an access boundary, not a finding that the opportunity is safer, superior, vetted, or suitable. You ask for time. You request the full documents, the fee schedule, the valuation policy, the liquidity terms, the conflicts, and the history behind the projected return. You compare the commitment with your cash needs, possible taxes, existing concentration, and the possibility of a substantial loss. The advisor remains polite. The room remains impressive, but the gold door has become only a door. You do not reject every private investment. You reject the idea that an invitation is evidence. You may invest, but only an amount that can remain unavailable for years after you can verify what you own, understand what it costs, accept how it is valued, and tolerate a substantial loss. You keep liquid reserves with their coverage limits in mind. You distinguish custodian protection from market protection. You reserve for possible taxes. You document family transfers rather than treating them as invisible favors. None of these steps guarantees an outcome. They make the decision more legible before money, taxes, and relationships become harder to separate. The advisor slides the signature page back toward you. This time, the door is not the prize. The prize is knowing what is on the other side, and knowing you can still choose not to enter. You qualify for the private deal. That doesn't make it safe. It makes the questions more important.